Imagine you are a very hungry mouse living inside the dark, dusty walls of an old kitchen. You pop your head out of a tiny hole and instantly smell something really delicious. Sitting right in the middle of the kitchen floor is a beautiful chunk of bright yellow cheese. Your stomach is completely empty, and this cheese looks absolutely free and completely untouched. So, you happily run out of the wall and grab the giant chunk of cheese in your mouth, but you instantly hear a terrifying, loud, metallic snap. You are completely trapped in a powerful mousetrap, and a giant piece of cheese was never actually free. The homeowner, Bill, specifically placed that exact piece of cheese on the floor to look incredibly tempting, knowing that your hungry stomach would completely ignore the dangerous trap. Smart money traders say these kinds of traps happen in the market all the time during a pullback of a trend. In an uptrend, when traditional price action traders see a move in the opposite direction, they simply call it a pullback. In this pullback, there can be multiple attempts to move back in the upward trend direction. Sometimes these attempts fail, and the price continues to give a bigger pullback. But smart money marketers looked at this very normal pullback and decided it needed a highly psychological, manipulative name. So, they call this small pullback an inducement trap. They tell their followers that the giant banking algorithm specifically created this tiny, weak move on purpose, just to trick impatient retail traders into entering the market too early. According to the Smart Money Dictionary, the evil banking matrix purposefully makes the chart look like a safe place to buy, like tempting yellow cheese on the kitchen floor. They believe that the bank triggers the early retail traders into the market only to instantly reverse the price and steal their lunch money before continuing the real, massive upward move. So, when a smart money trader sees a tiny pullback happen before a major support area is actually reached, they refuse to touch their mouse. They say that a multi-billion-dollar banking ghost specifically placed an inducement trap. So, instead of looking at things as weak and strong support areas, they nervously wait for the imaginary evil bank to finish trapping everyone else first, and then give them the real buying opportunity. But this time, the idea of not buying during tiny pullbacks at weak support areas is not really a bad idea. Even in traditional price action, it is recommended to avoid buying at weak support areas and to prefer buying at strong support areas. But calling it a trap and using confusing names like inducement and evil banking algorithms is not solving any problem. It is just creating more confusion for beginner traders.